The greatest investor of all time is Warren Buffett. If he had invested $1,000 in his investment company when it first began, it would now be worth almost $30 million. Such profits would seem improbable, so how did Buffett manage to achieve them? The truth is that he comprehends what most individuals do not, and he is adhering to a few fundamental ideas that you can use in your day-to-day activities. You will learn all of them by the end of this movie, so keep watching. When hiring new employees, we evaluate candidates on 3 criteria: intelligence, drive or initiative, and honesty. The first 2 will kill you if they don't have the latter, because you want someone without integrity who is lazy and stupid. The answer is that investors act very humanly, getting excited during bull markets and saying things like, "I made money last year, I'm going to make more money this year, so this time I'll borrow, or the neighbor said, I wasn't in last year when that neighbor was dumber, then I made a lot of money, so I'm going in this year's market." They constantly look in the rear view mirror, and when they see that a lot of money has been made in the past few years, they plunge in and just keep pushing prices up. And when they see that no money has been made, they just say that this is a bad place to be and they don't care about the state of the underlying business. It's amazing, but that creates a huge opportunity. Just huge. Ben Graham taught me to shop quantitatively and look around for bargains when making purchases, and that I was taught that, let's say in 1949, or they had a significant impact on me. So I went around looking for what I call cigar butts of stocks. The cigar butt approach to buying stocks is that you walk down the street looking around for cigarette butts, and you find this genuinely awful-looking, soggy, ugly-looking cigar with 1 puff left in it. But you pick it up and you get your 1 puff. It's disgusting, so you throw it away, but it's free, or at least inexpensive, and you can find another 1 puff cigarette somewhere else, and that's what I did for years. It's a mistake because even though you make money doing it, you can't do it with a lot of money. As a result, I'd now prefer to buy a wonderful business at a fair price than a fair business at a wonderful price. However, I have an antiquated belief that I should only expect to make money from things that I understand. By understanding, I don't mean knowing what the product does or anything of the sort. I'm talking about having an understanding of how the business's economics will likely be in 10 or 20 years. I have a broad idea of what Wrigley chewing gum will look like in 10 years based on economic projections. The way people chew gum and which gum they choose to chew won't change as a result of the internet. If you control a significant portion of the chewing gum market and have brands like Double Mint, Spearmint, and Juicy Fruit, those brands will still be available in 10 years. I can't predict exactly how the numbers will look for Wrigley, but I won't be far off. If I tried to anticipate something like that, evaluating that business would fall within what I refer to as my circle of competence. I am aware of what they do, how the economy works, and how the market is competitive, but the biggest errors I have made have been omissions rather than commissions. I mean, the things that hurt were those that I was sucking my thumb because I was competent enough to do them. They never appear. I probably cost Berkshire at least $5 billion, for instance, by sucking my thumb around 20 years ago when Fannie Mae was having issues, and we were going to buy the entire company for almost nothing. If it's Microsoft, I don't care because I don't know it. I don't have any reason to believe I'm entitled to profit from Microsoft, cocoa beans, or anything else because they aren't in my circle of competence. But I did have the knowledge to understand Fannie Mae and blew it because it doesn't show up in conventional accounting, but I know the cost of it and that I passed it up because those are the big mistakes that I've made, and I've had plenty of them. Unless I disclose them in the annual report, and there are significant opportunities in life. We don't do many things, but when we get the chance to do something important and proper, we must take it. Even doing something on a little scale is a mistake. Since there won't be 500 fantastic possibilities, almost is not doing it at all. Instead, you should seize each opportunity as it arises. It would be better if you received a punch card with 20 punches when you graduated from college, with each punch equaling one more opportunity to accumulate wealth. Let me know in the comments if you have any other questions about investing. Let's return to the video. In terms of our wholly owned businesses, we're not going to sell no matter how much anyone offers us, such as if someone offers us 3 times what something is worth, that is Candy the Buffalo News Board. Each of you attended a cocktail party where someone talked about a company that he didn't even understand what they did or couldn't pronounce the name, but they made some money last week and another one like it. You wouldn't buy it if you only had 20 punches on that card. I could be incorrect in my approach, but I know I wouldn't be if I had 100 Berkshires, since that's how I want to live, and I have all the resources I could possibly need. It simply comes down to which. If someone waved a large check in my direction, I wouldn't hesitate to change the newspaper account of my obituary, the amount of money the foundation has, and my relationships with people I like, and those who joined me, because they believe it was a permanent home. To do otherwise would be equivalent to selling one of my children in exchange for a hot big chick. In order to prevent them from disappointing me further, I want to let my partners know that I won't do that. We currently take that approach with some stocks. However, if we were constantly short on cash and faced with a plethora of opportunities, we might adopt a somewhat different strategy. Instead, our tendency is to hold onto our investments unless we become extremely discouraged, perhaps with the management, or we believe the economics of the company change significantly. That occurs, but we won't sell because it appears to be too expensive in all likelihood. So let's go on over here. The intrinsic worth of a corporation is the sum of all the cash that it would have given you between now and Judgment Day, discounted at the appropriate discount rate, provided you knew everything about the future. In other words, the only goal of investing and spending money now is to reap rewards afterwards, correct? That is the essence of investing. It is quite simple to determine the value of a bond when comparing it to a stock or a bond issued by the United States government, because it is clearly stated on the bond when you will get interest payments and when you will receive the principal. The cash flows are printed on the bond. They aren't printed on a stock certificate. Therefore, it could alter tomorrow if interest rates change. The analyst's responsibility is to print out the stock certificate that reflects an ownership stake in the company, convert it to a bond, and then state how much it will pay out in the future. You all learn it in business school, but it's the same for a large company. When we, buy some new machinery for Shaw to create carpet, that's what we're thinking about. If you were to purchase Coca-Cola at its current market price of between $100 billion and $150 billion, would you do so in order to receive the benefits the company will provide you with over the course of the next 2 or 3 centuries? Of course, if you had $100 billion or $15 billion, you wouldn't be listening to me, but I would be. As you extend the date, the discount rate doesn't really change. How much money will they provide you is the question after all. This isn't a question about how many analysts will suggest it, or what the stock's volume is, or what the chart looks like, or anything. It's a question about how much money it will net you. The only reason it's true is if you're buying a farm. If you're buying a house, an apartment, a financial asset, or oil in the ground, you're spending money now in order to receive more money later. The question is how much you'll get, when you'll get it, and how certain you are of getting it. Because that's how I think about it. Whether I determine an organization's intrinsic value or when we buy an organization, I always assume that we are purchasing the entire organization. I consider it and ask, what will result from this business? You obviously like them, should be able to use the money they make and grow the returns on it over time. For example, Berkshire has never paid dividends to its shareholders. But as the value of the companies we control rises, so does our capacity to do so. We can internally compound it. But the fundamental query is, if you're going to purchase the entire business for $105 billion right now, what can we distribute from the 100? When it comes down to it, the decision to purchase the shares depends on whether we can give you access to enough cash soon enough to make doing so financially advantageous at the current interest rate. You can bet in the stock if you want to, or your neighbors can buy it. But if you don't know the answer, and if you're asking about online firms, for instance, I can't either. I can't answer for many different types of businesses, but I just avoid them.
Hope you have learned something from this video. What are your thoughts? Comment down below. If you enjoyed this video, make sure to click the like button, and also don't forget to subscribe to the channel and hit the notification bell for you to be updated on our latest videos. See you in the next video. Thanks for watching. Want to learn more and be more financially literate? Click on the next videos we have in our channel, showing on the screen right now.